Hey, everybody. Welcome to the podcast. Thank you for joining me. Appreciate it. Today is June 10th. The market is closed and kind of a flat day today. Really not a bad day overall, given that the stock market had every reason in the world to really fall, and it didn't really dramatically. I mean, the Dow Jones actually was up 3 points on the day. The S&P was pretty much flat. But we did see some weakness in small and mid-sized companies, and they've been leading the way recently. And we did see interest rates up. So there seems to be some, at least in the last few days and a couple of weeks, we've been seeing money move out of bonds into stocks. In fact, if we jump over there real quick, you can see the Treasury rates. You know, they had been persistently falling, which was a concern for many because many investors look at that and say, well, if the economy is so great, why on earth are interest rates falling? Shouldn't interest rates be rising because the economy is getting better? And yet they were falling. And now that you see that it's actually changed direction. So we were kind of in this little channel here, and it broke down, and we got down to the 2.4 level one day, and it reversed and actually has been going straight up since. So that is good from the stock market perspective, that we're starting to see some selling of bonds and buying of stocks. If we flip back to the S&P 500, you can see this kind of uptrend we were in has actually changed trajectory, and it's actually going up at a faster rate now. But I will say all indications, at least the way we view it, are that we are destined for some type of short-term correction. And here's the way to handle that. I'm not going to, as many of you know that have followed me for years, I'm not going to predict and say that we're going to have a 5% correction, because more than likely I'll be wrong. It could be 4, it could be 6, and I'll be wrong. We could go up and I'll be wrong. So there's a better chance than not that I'd be wrong, and I don't want to be wrong. So rather what I'll do is I'll tell you what we're looking at, and that the odds favor that the market may take a pause here. I think from viewing Twitter, from listening to interviews, from doing the reading that I do, I think there's just as many people that do believe it's going up as there are people that believe it's going down. Tons of people have been calling for corrections. We haven't had one. We haven't had a 10% correction in almost 2 years. And there's tons of people that are calling for one. But there's a lot of people still that think it's going to continue to go up. And who knows? All I know is that I think in the big picture, a lot of our longer-term indicators are still positive. It's the shorter-term indicators that I'm kind of worried about, again, in the short term. And it's things like when you look at the advanced decline line, there's a ton of stocks that are going up right now. And that may sound great and all, but when every stock's moving in the same direction, it just gets too stretched. So as opposed to looking at it as a line going from the left to the right of your screen, look at it as a band, and we're at the upper end of that band. Also, we posted something on eggerscapital.com, which, by the way, if you haven't been there, go check out eggerscapital.com. We've got a new article that we put on there today. And one thing that we did, and it wasn't our idea, we just took it and tweaked it, but we did find some research that was showing that volatility has been low. And we know a lot of people are looking at the VIX, and the volatility index, called the VIX, is really at these extremely low levels, going way back. And this is normally the time that you might get some type of stock pullback. Well, you know, you could have said that here, and yet we continue to fall. So volatility is very cheap right now. That's not the only reason you should be selling stocks. In fact, this looks very similar to the beginning of 2013, right after the fiscal cliff. Remember that? New Year's Eve. Well, fiscal cliff ended, no big deal, and the stock market zoomed up. So just because the volatility index is low, that doesn't mean you sell stocks. But there was a gentleman named David Bianco who does some pretty good research, showed that, hey, if you take a look at the PE ratio of stocks, so what you're paying for stocks versus the earnings, and you divide it by the volatility index, you get this ratio. And the ratio he showed, and I'll show it to you here. Again, if you haven't read the article, this is basically it. So we have this ratio, and in the blue, the dark blue, is the S&P 500, going all the way back to the 90s. But in the light blue is the PE ratio divided by the VIX. Now, what we did was we said, look, they were looking at quarterly VIX ratios and numbers, and we said, let's look at it as the latest PE. So we got the latest data. Let's divide it by the latest volatility index reading. So we're getting the most up-to-date data we can get. And so same premise and very similar type of numbers. But basically, we drew this arbitrary line here, and what it showed was that every time that we get up to this level where that's basically saying stocks are expensive and, this is the important part, and volatility is very low. So you have complacency plus an expensive stock market. And each time that we've hit this line, we've had a pullback. Now, just at first glance, you'll notice this and go, well, hey, it didn't really work here because it was way up here and the stock market was just about to embark on a huge run. Well, there's a lot of ways to look at this. First of all, every time it did hit here, we did have a pullback, and it was about a 5% pullback. That was first of all. Second of all, as the market moved up, this isn't used for a long-term indicator. Don't look at this and believe that, well, it's up at these levels, surely this is the top and we're going to have a bear market. That's not the point of this. This is just saying that we are at a level right now where corrections have happened in the past. However, there have been times where it's happened multiple times, like here, and eventually it led to a stock market top. And there's reasons why, it was falling here and the stock market was going up. The bottom line is what we want you to take away from this is that we're reaching a level on this indicator showing complacency and stocks are a little more expensive that we haven't seen since going back to the prior to the financial crisis. So what I would say is we're in the first innings of perhaps we see a few of these in a row. But the thing is, each time this has happened, we've had a 5% correction. And that's all David Bianco was saying was he thinks the next 5% is going to be down rather than up. And I would tend to agree, not only because of this indicator, but several indicators that we're watching. And it's just a situation where the market stretched a little bit. You look at lots of these oscillators we look at. And oscillators, all there are is if you view the stock market kind of like or some of these indicators like a pendulum. They swing from one side to the other. We are extreme right now where it's very pushed to the extreme, and we should pause at the very least, if not fall. So here's the way I would handle it. Don't run out and sell all your stocks just because you hear some guy on this podcast showing you charts and screens and all that. That's not the point of this. The point is if you have cash you've been wanting to get and you want to put it to work, wait. That's all we're doing. And so we've been taking profits in the last several days on companies like, and this is in our aggressive strategy, we tend to trade more. JetBlue, we've taken profits on. We bought it really close to the bottom here, had a nice run. We took profits on it. We took profits on the Russell 2000. There's lots of things that we bought during this little panicky area and we took profits on. But the thing is that money that we took profits on and is sitting in cash, oh, by the way, we also took profits on REITs. We owned a Schwab REIT ETF, and you can see they've had 3 down days in a row here. Not dramatic, but this uptrend they've been in has been broken, and so we took profits on that in another strategy of ours where we use primarily ETFs and rotate around. So we've got some cash built up. It's not a tremendous amount, but here's where we stand. We feel like we can afford to sit and wait while these indicators are stretched rather than getting that cash put to work immediately, let the market come back in a little bit, and then redeploy it. And if we're wrong and the market keeps going, so be it. It is a high-risk time in the very short term. It's a high-risk time to buy stocks. This is an extreme, okay? That, again, doesn't mean it can't keep going up, but a lot of the indicators we look at are at extremes. So for us in the short term, we're watching this. You might even, if you're somebody that is looking at this and saying, well, I need to get invested, you can average in over time. So if it doesn't pull back, you can get in. But I'm talking for most of you that are invested, maybe you took some profits, or should you put that money back to work right now? I would say no if you're in I'd say comfortably long position. The chart that you might want to be looking at here is the hourly picture. This is an interesting picture because you can see that we're stretched on the hourly just because, again, we are in this tight band, and here we are way at the top. And if you look at, again, some of these oscillators, they're pointing towards the fact that we could see a pullback. Is it a pullback that goes down to here? No, that's not what we're saying, but we could see something that pulls back maybe to the old breakout. That would be a 40, 50 points on the S&P. That's 2 or 3%. But in a bull market, that's the pullback that you're looking for. So if it starts to pull back, don't get too greedy and say, well, I'm going to let it be a 5 or 10% pullback. Okay, and again, that's if you're underinvested and want to get it invested. Those are the levels that you need to buy at if that's what you want to do. Again, I don't know your situation. I'm just telling you, generally speaking, kind of what we're thinking. Now, getting back again to interest rates, we've seen a there was a breakdown of this level here, and this was an important level we broke, which was right around, let's call it the 245, 2.45% on the 10-year Treasury. That broke, and what happened was when it broke, you had a lot of stops get taken out. And when you had a lot of stops get taken out, of course, it reversed intraday because all those stops got out of the way, and then people started selling Treasury bonds. Interest rates went back up. This hasn't changed the pattern. It just confirms that perhaps we're in this band or this range where, this is the top and this is the bottom, and this is the box you're in, somewhere between 2.4% and 3%. If the economy gets horrible, we're going to go down to 2.4 and probably break it. If the economy keeps picking up steam, you're going to go on the upside here. So, and overall, the jobs report was kind of a dud last week, so it didn't move much. And really all we see going on right now is things like utilities right now seem to be putting in a double top. That was another area we got out of, but utilities seem to be putting in a double top right here. So we have that happening. Plus, I already mentioned REITs. If you look at the Russell 2000, I put this out on Twitter today. If you don't follow us, it's twitter.com/Carl Eggers. This is a potential head and shoulders top. Maybe I shouldn't use circles, but you get the idea. Left shoulder, head, right shoulder. So we could be breaking here. And there's some out there pointing out that, hey, the last time we saw this type of pattern on the Russell 2000, which is small stocks, was 2011. If you recall, 2011 in the summer, we went down in just a few weeks by about 22% from top to bottom. Very nasty. So watch that because volatility is low and risk can happen very fast where it picks up steam. But I think what's happening right now is really there's just selectivity going on. There's things that are still making money. There's rotation going on. In fact, today, one of the biggest areas that got some of the juice, and we own this in our aggressive strategy as a trade, is the junior gold miners. Those were something that really showed a lot of big volume on the day. If you notice down here, big volume on the day, about 6.7 million shares traded. And, could we be breaking out? This could be, on the other hand, inverted head and shoulders, which means it's a bullish pattern. Left shoulder, not the left head, that'd be kind of weird. Left shoulder, head, and is this the right shoulder? So look for this to continue, and if this is a pattern that you're buying, your stop would go right here, if that's why you're buying that pattern. If you're buying it for other reasons, you can continue to hold it, but if it breaks down here and breaks that, then the pattern's no good anymore. So gold miners did pretty well today. Also, take a look at the semiconductors. If we take a look at the overall semiconductor index, this is the SOX, which is a ETF you can buy. Same kind of similar pattern to the S&P, but a little bigger boost. You can see this has made about 9% during this run since mid-May. So semiconductors leading, which is really good. We want that strength in semis. We want the strength in financials. We want the breadth to continue. And right now we're seeing it. But again, short term, things have gotten a little extended. So let it rest a little bit before it comes back. But overall, I would say, there was a trade in there where small caps really underperformed. And there was a trade in there where we jumped on that, made a quick few percent, and got out. But overall, the theme the last few years has been the big, huge blue chips underperforming, and now maybe they start to outperform as we move into a new phase of the stock market cycle where the stock market is about the big blue chips. Because remember what happens as a bull market morphs into a bear market, that takes multiple months. And as it happens, money goes out of the riskier stuff and into the safer stuff. Now, we saw a little glimpse of that a couple of months ago, didn't we, where the biotech fell, the Netflix and Teslas fell, and some of those have bounced back. But are they going to make lower highs? If you look at a company like Facebook, which was up about 4.6% today, it was on this nice run, wasn't it? And then it broke, and it's rallying now. If it doesn't get back up to the old high and rolls back over, then you could say, okay, that was a failed attempt, and this whole thing's rolling over. So companies are doing that. Russell 2000 could be doing that. Here's the three bottoms. But if it gets up to the top here and doesn't make a new high, then you could say it was a failed attempt and we could be heading down. As that happens, money doesn't leave the market. It simply moves up the safety chain and goes to the Johnson & Johnsons and Cokes and things like that and moves into the Dow Jones. So watch that transformation. But I think the longer-term indicators are still pretty good. I don't see any evidence yet of a bear market ensuing. But I do think in the very, very short term, a correction is not only certainly due, it's one that appears to be maybe upon us, but we'll see. I mean, today was a good example of the stock market could have sold off, should have sold off, and here we are finished flat on the day. So don't assume a correction is coming just because these indicators are stretched, but prepare for it, but just don't overdo it because the odds still favor in favor of the bulls really in the medium term. So if you're somebody that does not like to do short-term trading, you're not looking at the next couple of weeks, you're looking at the next several months, maybe you don't do anything. But I think if you have some things that have run, don't be afraid to take some profits on them. All right, guys, have a wonderful evening. Hey, don't forget eggerscapital.com, iTunes, Facebook. You can like us on there. Twitter.com/Carl Eggers. We're on all those places. And also we have our weekly radio show called The Eggers Report, Your Investing Playbook. All right, we'll talk to you soon.